In today's video, we are going to discuss how to maximize the cash value of a life insurance policy. We're going to look at an individual that has a plan set out. He knows the exact dollar amount he's going to fund the policy. He knows how long he's going to pay into the policy. And this illustration looks beautiful. It's exactly what he wants. But then life happens and he can't pay another penny into the policy only after a couple of years. Have you ever been in a situation like that? Maybe it's with a life insurance policy. Maybe it's with anything. I know when I first got into this business, when I first got my life insurance license back in 2011, I thought things were going to be great. I remember talking with my brother. I think it was even before I got my license or right after I got my license. I'm like, here's the car I'm going to get because I think I'm going to do so well that I'm just going to be rolling in it. Yeah, reality struck very, very quickly, and I almost failed out of the business multiple times. The first year I made $5,500, like that was gross before tax, and the next 2 years were just a little bit more than that. So I had this plan. I was looking at the car I wanted to get. I was even going to dealerships with my brother thinking, hey, I'm going to be able to get this no problem. And I looked like a fool. And I still look like a fool many times up to this day. My point is, I had the plan set out. Things did not go according to plan. Back to cash value life insurance. This individual we're going to look at has a plan to fund the policy at $100,000 per year for 10 years. So he wants to get a total of $1 million into this policy. He wants maximum cash value, but then life happens. After only 2 years, he planned to get $1 million into the policy, but he only gets $200,000 into the policy. He cannot pay another penny into the policy. Now, he's not committed to the $100,000 payment. Of that $100,000, his minimum commitment is approximately $10,000. So that's his true minimum commitment. He's really been stuffing the cash value. But year 3 comes and he says, Steve, I cannot pay anything into this policy, not even the minimum. What's going to happen? I know we planned for X. I was going to get $1 million in, but I can't do it anymore. What are my options? So thankfully, he has a number of options, which we're going to look at very soon. What I want to hit on first is when we look at these scenarios, whether you're considering a new policy or if you already have one in force and you wonder about this, for some additional awareness, what's good to look at here is reviewing the guaranteed values. This allows you to stress test the policy in not just a worst case scenario, we're going to call it a double worst case scenario, meaning worst case scenario here, I had to really cut my funding short. We equipped the policy, we designed it to be able to handle funding of $100,000 per year for 10 years. So we had to overinflate the MEC limit, get a little bit higher death benefit than what we normally would. Now we're going to cut it short after 2 years. What do we do? So that's a worst case scenario or a bad scenario. Now we're going to make it look even worse by looking at the guarantees only. This allows you as the policyholder to see a situation when we review the worst case scenario and give you a solid answer, yes or no. Will the policy lapse? Will it blow up? Is there any chance that I can lose money? And the answer is no, if it is designed properly. It's so important. I'll touch on that when we hit the numbers. But let's look at the numbers. We will look at the guarantees. First, we will look at the current dividend interest rate. So here we've got an example. Dividend values. This is an example with Guardian. Their dividend rate is 5.65% for 2022. 45-year-old individual, $100,000 in. First year cash value, $82,000 and change. Death benefit, $2.8 million. Next year, he pays in $100,000. His cash value grew from 82 to 180. So if he was earning 0% and he pays in $100,000, the cash value would grow what? From 82 to 182. So he didn't quite get all of his money back. Worst years about a life insurance policy, first 2 years of a life insurance policy. Best years, every year after the first 2 years, where the policy is compounding, our minimum premium starts to come back to work for us. So what you see each year is more and more of your payment come back to work. And between years 5 and 6 is our break-even point, when you now have more money in cash value than what you have paid into the product. The specific breakdown in this example, this is an important side note, which we cover in a lot of our other content, is of that $100,000, his actual minimum premium is $10,000. So that's his true minimum commitment. It's a little bit higher than that. We have what's called a term insurance rider attached as well. That prevents what's called a modified endowment contract, a taxable event. But my point is, his true minimum is $10,000, and he's plowing as much money as he can toward what's called a PUA rider, which just accelerates the cash value growth. So it's designed properly for maximum cash value. So each year continues to pay in. He gets $1 million in, and he's got $1.1 million. So before we look at the life happens scenario, what do the guarantees look like in this scenario? Beneficial to see that. So as we take a look here, here is exact same policy, but assuming no dividends are ever paid. So here, same thing going in 100 grand. What do you notice on the break-even point? Up here, it's between years 5 and 6. This is realistic. Guardian's one of your major mutual companies. We track the actual performance of policies we put in force and older ones. We've seen them always deliver when the policy is properly designed. But if you like to look at things conservatively, from a peace of mind perspective, this is always good to look at. There's your guarantees. Break-even point is between years 10 and 11, much longer. If someone's not comfortable with that, whether this is realistic or not, if you're not comfortable with it, it's very important to see it up front. If you make the decision not to move forward, that's okay. Very important to have that awareness, though, in my opinion, with any financial product or any purchase. But there's our cash value over time, nothing paid thereafter, and this is the guaranteed values. So no dividends are ever paid. The guaranteed rate is 3%. However, that is a gross rate. Anytime you see a guaranteed rate or a dividend rate on a policy, it's not what we're actually earning. We're going to look at the net internal rate of return. But my point here, guarantees, we see the values continue to go up. Now, with that said, life happens. I can't pay a penny into the policy. Now what happens? So we just looked at the 10-year example. Here's the exact same policy. Dividend values first. What do you notice here? Year 1, cash value is $82,000 and change. Year 2, you're paying 100 grand again, so you funded it just for 2 years. Cash value is exactly $180,000. Let's go back to the 10-year example. What's at the first and second year? 82 and then a clean 180. So things are identical for the first 2 years because you're paying money into the policy. How about year 3? What do we notice here? You don't pay a penny into it. What's your cash value grow by? 0 out of pocket. There's a premium due, but you're not paying it in this example. The policy's paying it internally through dividends and interest. Grows by about 4,000, almost 5,000 when you look at it. Continues to appreciate, just about positive by year 6. You've paid a total of $200,000 into the policy. You've got $199 and change. We can get that to $200, especially if he has the top health class. This is regular preferred. And then year 7, he's positive. He has the option to continue to make payments here, but he doesn't. We stop payments altogether. You will notice a steep death benefit drop after the first 7 years as well. That was a manual adjustment we made to remove the term rider, eliminate the premium. Basically, we reduced the death benefit to reduce the insurance expenses and increase the cash value growth. So based on the present dividend values, doesn't look bad. How about guarantees? What does this look like? Not as attractive. What do your values look like? Do they go down? For a little bit they do. Does the policy lapse, or does it ever call for more money though? That's a big thing we want to look at here. And the answer is no. So here we go. There's your funding for 2 years. Year 1, 82,000. That's the same as the dividend values because no dividends are paid in the first year. That's why we see identical values there. Not with this company and product at least. No payments indefinitely. And you'll actually find year 3, when you don't pay anything into it, cash value decreases by a slight amount. and watch it continue to gradually decrease. And then look what happens with the death benefit. We reduced it here. Now your cash value begins to increase. So by reducing those insurance expenses, we're able to enhance the overall cash value growth. Now, a question that comes up sometimes here is the death benefit was reduced at year 7. Can I reduce it in year 2 if I have to stop funding there to get stronger cash value growth? The answer is no. So the reason why is when we look at a cash value life insurance policy, the core benefits around the cash value, what attracts so many people to this product, are as follows. It is a safe, liquid, tax-free area to position money. Tax-free if we do everything properly. Any life insurance policy, cash value life insurance policy that is, can become classified as this, MEC, which stands for Modified Endowment Contract. If your policy becomes classified as a modified endowment contract, the tax-free benefit is out the window. Technically what happens is your cash value still grows tax deferred, so as it grows, you do not have to pay any taxes on it. However, if you ever want to access the cash value, what happens is that income tax and a 10% penalty tax, if you touch it prior to age 59 and a half, is due on the gains, which it ruins the policy benefits regarding the cash value. The death benefit's still tax-free, but the cash value is not. So what this has to do with not being able to drop the death benefit after 2 years is every policy has a MEC limit or a MEC test. Another name for the MEC test is our 7-pay test or a 7-pay premium test. To simplify, the first 7 years of a life insurance policy are where the vice grips are very, very tight from the IRS on life insurance policies. What determines that MEC limit, that MEC test limit, is an individual's age and total death benefit on a life insurance policy. So if we were to reduce the death benefit prior to the first 7 years, we can run into a modified endowment contract. This particular example, we do have some room to look at a partial reduction here. We can't always do that. It depends where we set our initial MEC limit. I know this is a bit technical, but that is something your agent will always review with you and present options to you on. Point here is if life happens, what happens with his policy, or if this is your policy? In a worst case scenario, takes much longer to recapture your money, but one could look at this and say, I paid in 200 grand, I get a guaranteed $400,000 death benefit, and the cash value does appreciate at a very, very slow pace over time. That is with an extremely conservative situation where the product and company has always done better than that, or the company, I should say, Guardian, any of the major mutual carriers have. And then we've got what they presently are doing and have been doing at their dividend rate of 5.65%. That's what it looks like. Hope you enjoyed this one. The next video, we are going to add a little bit more on top of this, looking at some additional scenarios. If you enjoyed this one, please hit the like button, subscribe for more. If you have any questions or would like to see specific scenarios, feel free to comment below or email us anytime. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.